Hi, everyone. Welcome, and thank you for tuning in to learn more about our IncomePlus Fund. I'm Ben Harris, Origin's Vice President of Investor Relations and Business Development, and I'm excited to be joined by Michael Episcope, Origin's co-founder and principal. Since Origin was founded in 2007 by Michael and his partner David Shear, our mission has been to transform the way that individuals invest in private real estate. And this fund is the next step of how we're carrying out that mission. We know that people are attracted to private real estate because of its low correlation to the stock market and its especially low volatility. However, we also know that people invest in private real estate for income, appreciation, and tax efficiency. And the IncomePlus Fund offers all three. In fact, Michael and his partner Dave have such strong conviction in this fund that they'll be co-investing $10 million. The fund is targeting 9 to 11% net annual returns, and that's inclusive of a 6% annual distribution, paid current and quarterly. So the goal of this webinar is to explain how the IncomePlus Fund is the optimal wealth building tool. During this presentation, Michael and I will cover Origin's background, the structure of the fund, its strategy, the terms, and then we'll also talk about next steps in case you'd like to participate. So with that, I'll hand it over to Michael.
Thank you, Ben. Appreciate that. And I want to also thank everybody who is listening today and taking time out of their day to hear and learn about the IncomePlus Fund. I am going to spend the next 25 minutes providing insight into why we launched the fund, talk about the structure, the strategy, and some of the ways in which this fund is both similar and different than our previous funds. And hopefully by the end of this webinar, your questions will have been answered about the fund and you'll have learned a lot more about the IncomePlus Fund and the way we operate at Origin. Let me start by giving you a bit of background on the company. Origin was formed in 2007, so we've been around now for 12, almost 13 years. And in the beginning, it really resembled more of a family office. The first two investors were my partner and I, and we built the company because we believed we could do it better than alternatives we were finding out there. And that's really the genesis and the notion of building a truly institutional quality company that only serves individual investors was unique when we launched the company, and it really resonated with a lot of people. And I'll just clarify, by institutional, what I'm referring to is everything from the way we structure the fund, to the quality of the assets we acquire, to the terms we put in the PPM, the fees we charge, and probably most importantly, the quality of the team. Our team comes from larger organizations like Equity Office, Starwood, Reef, but large institutional organizations, and they bring institutional best practices to Origin, and it's one of our differentiating features that when you invest with us, you have this amazing team who's out there looking for deals, sourcing deals, managing deals, reporting to you, doing everything, just giving you the feel of a multi-billion-dollar organization, but at a place like Origin. Now, today we have more than 650 investment partners who are served by approximately 30 team members here at Origin. We have 4 offices throughout the country. We are headquartered in Chicago. We also have offices in Dallas, Charlotte, and Denver. Those offices serve as deal sourcing hubs for the team. One thing that we fundamentally believe in is that in order to be successful in real estate, you have to understand the local market. You have to understand where the growth is happening. You have to have the relationships to win bids. And that has been a transformational shift for our company. And I think one of the really unique differentiators is that our deal sourcing team members live and work in their markets. And they know the fundamentals of real estate, and they know block by block where things are happening. And it truly is a distinct advantage to source deals on and off market, to underwrite them more accurately, to win deals, because this still is a relationship market. And even when we're not the top bidder, we tend to get the last look at the deals because of those relationships. And today, it's helped fuel the growth of the company immensely. The core strategy is that we acquire and develop multifamily properties in 10 high growth U.S. markets. We are in Denver, we're in Austin, Houston, Dallas, Raleigh, Atlanta, Charlotte, Nashville, Phoenix, and Orlando. These markets have been chosen based on one thing, and that is the outlook for growth. We want to know where the population growth is happening, where the job growth is happening, because real estate investment performance is highly correlated to job growth and population growth. And these 10 cities that I just named are consistently ranked in the top 20 U.S. markets. We've had tremendous success over the last 10 years. Our Fund 1 generated a 28% net IRR and a 2.3 net multiple. Fund 2 generated a 21% net IRR and is on track to generate a 2.1 net multiple. And we are in the process of investing Fund 3 right now. That is a $151 million fund that we are 72% invested in right now. And we have another 2 properties under contract that will bring that up to about 85% invested by the end of Q2. But one of the things I really want people to understand more than anything is that they are betting on Origin and our team and our ability to execute. And we are going to execute this fund with the same discipline as we have in the past and take what the market gives us in any given year and hopefully more as well. Our goal as a company is always to outperform other managers in our peer set, whether it's Blackstone, Carlyle, or smaller managers, because that's what we do, that's what we've done, and that's why my partner and I are investing significantly in this fund. Many people who have invested with us in the past, or maybe haven't, they've been asking us, when are we going to launch Fund 4? And the simple answer is that the IncomePlus Fund is Fund 4. And there's some reasons why we didn't name it Fund 4, but the core strategy is exactly the same. We're buying core plus and value-added multifamily properties in our 10 markets. And the goal with any change we make to a fund is to make the fund a better version than the one before it. Fund 2 was a better version than Fund 1. Fund 3 was a better version than Fund 2. And the IncomePlus Fund, we believe, is a better version than Fund 3. And the most significant change between this fund and our previous funds or even other funds in the market is that we've moved from a buy, fix, and sell strategy to a buy, fix, and hold strategy. And the reason is simple, because we fundamentally believe that real wealth is created by holding quality assets forever, not by trading in and out of them, right? And so as a result, when we change this strategy from buy, fix, and sell to buy, fix, hold, and I'll talk about the reasons why this makes so much more sense, but the fund is now structured as an open-ended and evergreen fund. And open-ended in our business simply means that investors can get in and out anytime. We've introduced liquidity into this fund, but liquidity not by selling assets, but by selling your shares. Evergreen means that it is perpetual in nature. So there is no end date or size limit to the fund. This fund might be $300 million in size, and it might be $3 billion in size. But again, every change we make is intentional and has a purpose, and usually starts with a question. And in this case, we asked ourselves this question: what if we executed the same strategy as our other funds, but instead of selling the assets, we held them? Does that create more wealth? Is that what investors want? And over, as we looked at it, the unequivocal answer was yes. And ironically, one of the biggest complaints we receive is when we sell an asset. And it might sound funny, but there's actually good reason for it, because it creates a problem for individual investors. We've generated great returns, but every time we sell an asset, the investor is faced with 2 issues. And the first is that a taxable event is created. They have to pay taxes on those gains. The second issue is that investors now have to find a new opportunity to put that capital to use. And oftentimes that money just sits around earning little to no return in a bank account for 6, 12, 18 months until they find the next opportunity. And when they do find the next opportunity, they're only able to invest 70 to 75% of the profits in that next opportunity because of the tax liability. And when you add up the issue of the cash drag, right, money sitting in a bank, and paying taxes, the impact to wealth creation is enormous. And while we did great in Fund 1 and Fund 2, and we'll do well in Fund 3, had we not sold any of those assets and had we continued to hold on to the higher quality assets in those funds, our investors would have done a lot better. But that wasn't our strategy at that time. But it doesn't mean it can't be our strategy today in changing some things. And that's what we were missing, was this idea was of eliminating cash drag and minimizing taxes to the greatest extent possible. But by structuring the fund in the way we are, we've solved both of these issues. And I can't underestimate tax efficiency. It's a huge issue and a driver for the way we put this fund together. And when you think about the reasons for being in real estate offers three distinct benefits over other investments. And the first is depreciation. And depreciation helps shield cash flow from taxes. That's one of the greatest advantages of holding real estate for the long term, is actually having a cash flow stream that comes back to you, in many times tax-free. Refinancing. A property can actually be refinanced an unlimited number of times, and capital return through refinanced isn't taxable. That means if your property doubles in value over 10 years and you take out money through resizing your loan, you don't pay any taxes on that additional on those additional proceeds. And if it doubles again and you refinance again, you don't pay any taxes. And the last tax advantage in real estate is that even when you do sell, you can defer those gains by utilizing a 1031 exchange. So when we talk about holding forever in this fund, yes, in many ways, but the reality is that we still have flexibility to get in and out of assets, so that if we see an asset that is 10, 20, 30 years old and we no longer want to hold it, we can sell that asset and roll those gains into another property. Let me point out a very tangible example of how the benefit of depreciation inures to investors immediately in this fund. And one of the questions we've been asked quite a bit is about the tax efficiency of this fund and the taxable nature of the 6% annual distribution. And the question is, will you pay taxes on the 6% annual distribution? The answer is that there will be almost no taxable income on this fund once it is fully invested. And the reason is simple, that we have enough depreciation from the real estate we own directly to offset any taxable income. So the distribution, the 6% distribution, can be delivered without any tax consequences. Now, will there potentially be some? Yes. But the way we're structuring this fund and the way we're modeling it today, it appears that we will be able to deliver that almost on a nearly tax-free basis. And to put that in perspective, you'd have to make nearly 10% on a debt investment to generate the same after-tax cash flow of that 6%. The next slide is really an illustration to drive home this point about chasing high IRRs, the tax consequences, the impact of cash drag. And what we've put together here is the wealth creation of two different strategies. The blue line represents the wealth created over 15 years through a buy, fix, and hold strategy that earns 10% per year in a very tax-efficient manner, and that 10% compounds year over year. This is the goal of the IncomePlus Fund. In this case, a $250,000 investment grows to a little bit more than $1 million over that 15-year period because of that compounding. And this is, by the way, on an after-tax basis, assuming that that 6% has no tax implications and is reinvested into the fund itself. And that's one point I'll talk about really quickly. There is a DRIP in the fund, meaning a dividend reinvestment plan. So if you want to take the income, you can. If you opt in for the DRIP, it means any distribution that you would have received automatically goes in and just buys more shares, no differently than you would on a stock. So that's something that really makes this fund perform more like a growth fund because of the compounding effect of reinvesting that distribution. Now, looking at that blue line, you can see we did do this on an after-tax basis because at the end of 15 years, when the investor decides to sell, taxes are due. And that blue line, the drop-off you see at the end, is the impact of the tax liability being paid. The orange line represents the wealth created by a buy, fix, and sell investment strategy that generates 14% per year. In this case, the assumption is that the investor makes a 14% annualized return for 3 years, sells the asset, pays the taxes, and then reinvests the remaining proceeds after 6 months. In both cases, you can see you get to the exact same place of wealth creation. The second place, the orange line, is much more complicated. I would argue that if you're in investments that are generating 14% return, you are taking more risk than one that generates a 10% return if you believe in market efficiency. To us, this is really the definition of a better risk-adjusted return. We are generating the same amount of wealth, in this case, at a lower unit of risk. Let me jump into the capital call structure and process as well. And the capital call process in this fund is simple. We call 100% of your capital at once. And this is another area where we discovered was an enormous pain point for investors. So we changed it. Calling 100% of your capital at once alleviates the hassle of capital calls and completely eliminates cash drag. Now you don't have to worry about figuring out what to do with your commitments while you wait for us to find a deal. All of your capital goes to work on day one. When you're looking at this fund, and I think it's pretty easy to understand why this makes more sense, calling 100% of your capital at once. And the reality is that generating 10% on 100% of your capital is far better than earning 15% on a much smaller portion of your capital. And the way it works is that anyone who signs up is essentially in a queue or a line. And if the queue is $50 million deep, and we find an asset that requires $20 million in capital, then we call the next $20 million in capital, and the remainder of that capital, the $30 million, moves to the front of the line. And any new commitments move behind that. So at this point, I've covered the fund structure, I've covered tax efficiency, I've talked about how distributions are going to work and capital calls. So now let me talk about the fund strategy and how we actually make money through property acquisitions. 75% of the fund's equity will be invested in value-added and core plus apartment complexes in the 10 markets we cover. 25% of the fund's equity will be invested in mezzanine debt or preferred equity. And I'll talk more about the rationale for why we're mixing equity and debt together in the same fund. But on the direct acquisition side, the typical property is roughly around 8 to 15 years old and in need of an upgrade. The costs range typically from $5,000 to $15,000 per unit. So on a 300 unit property, we might be spending anywhere from $1.5 million to $4.5 million to upgrade the property and bring it up to today's standards. We'll upgrade the units, the clubhouse. Those are areas that we tend to focus on. And another area that we focus on quite a bit is replacing management. And by changing management and offering a better experience to our tenants, we can improve occupancy and rent significantly without spending much money at all, because management almost in every case needs to be replaced. The bones of the property and the location is another area that we spend a lot of time on. These have to be great because these are areas that we can't change. Everything I talked about just before, the interior of the units, the clubhouse, the fitness center, those can be changed and upgraded, but the bones of the property can't be changed, and neither can the location. And ideally, what we're looking for are properties in infill locations, close to highways and retail amenities, because these are the things that renters care about. And the renter that we're looking for is one called a renter by choice. A renter by choice is a person who could buy a home but chooses to rent for the lifestyle and flexibility. These are well-educated individuals who tend to have higher incomes, and that's important in what we're dealing with, because our primary goal when we get in there and we improve a property is to raise rents, and we want to make sure that people have enough disposable income to be able to afford the higher rents. So affordability is a metric that we look at quite a bit when we're going in and evaluating a property. But when you think about this renter also being well educated, having a college degree, and oftentimes having a postgraduate degree, they're less likely to lose their job if and when the job market does turn around, right? They're more likely to keep their job in a bad market. And so that really insulates us more so in a downturn, insulates the occupancy and bad debt. So that's one of the ways in which, when we're looking at, from a macro world, and we're choosing our markets and our submarkets and the location of the property and the renter, how we mitigate risk throughout the process and every choice we make. The last thing I'll talk about in this segment, when we're buying properties directly, we typically leverage around 2-to-1, which means we're putting about 65% debt on the property and 35% equity. And we utilize non-recourse debt so that the fund is not guaranteeing any of the property debt along the way. So this is slightly lower leverage than what we've used in past funds, and again, keeping with kind of the lower risk to generate the same or more wealth in this fund. That's consistent with that theme. Let me talk about the debt portion of the fund right now, because 25% of the fund's equity will be invested in debt products. We will be originating preferred equity positions and mezzanine debt positions in properties that we know and understand, and in markets we know and understand. And it's really our experience on the equity side of the table that enables us to evaluate opportunities and manage the risk set. We typically, when we do originate debt, we will require 15% to 25% above us, so we have a nice cushion. And on top of that, we're lending to properties that we believe will work, that we believe will create value, with sponsors who have a history of making projects work as well. And that's one of the most significant ways, is we've done a lot of joint venture over the last 10, 12 years. And we really have a great understanding for how to evaluate and underwrite the people who are responsible for building value. Now, the debt portion of the fund really adds 3 distinct components. And the first is that it reduces risk to the entire fund. And really, because we're in a protected position in the capital structure, we sit between the equity and the senior debt. And we don't really feel like we're sacrificing the upside by being in the debt portion of the capital stack, because we're getting paid anywhere between 10% and 14% on an annual basis. Now, the second reason that debt makes sense in this fund is that it produces stable and predictable income. And one of the components of this fund is produce and generate a 6% yield. So this is a really, really important factor in being able to do that and deliver that on a consistent basis to our investors. The third thing that it does for the fund is that it reduces volatility, because private debt doesn't really fluctuate in price. And I guess the way to sum up the debt portion of the fund, and you can think about this as a hedge against the equity side without much sacrifice on the upside. So we believe that this is a great addition to the fund. Now, normally, debt has some downside as well, and I'll talk about those here and how we're overcoming those. And the first is, in a debt position, because you're protected, you don't have unlimited upside. So that's a trade-off, and there's nothing we can do about that. But we believe that we're getting well paid for the risk we're taking. The second thing about debt that makes it a difficult investment is that it's extremely tax inefficient. In fact, it's probably the most tax inefficient investment out there. However, and this is one of the unique features of this fund, by pairing our debt with direct ownership of equity investments in the same fund, we can shield nearly all of that income from taxes. And here's why. It's called excess depreciation. We have more depreciation from the properties we own directly than we need to offset the income from those properties. And so that excess depreciation is used to shield the income from the debt products. So the debt is really a critical component in this fund to not only reduce risk, but to be able to deliver that consistent, stable income to investors as well. Hopefully I've given you some insight into the makeup of the IncomePlus Fund, the strategy, the changes we made, why they're more beneficial. And really every decision we make is about minimizing downside risk without sacrificing upside. So this fund really embodies everything we've learned in the last 10 to 12 years. I'm excited about the fund, and I truly think it's the best fund we've ever delivered to the market. And hopefully I conveyed this to you, and also I conveyed all of the reasons why we made the changes that we did and how they're beneficial to you. So thank you very much for listening. I'm going to hand this over to Ben now. He's going to talk about the fund terms, how you can subscribe, and where you can get more information. Thank you. Ben?
Thank you, Michael. Now I'll cover the terms of the investment. So as we alluded to earlier, this fund is perpetual. It's open-ended. That means it does not have a target end date. And because of that, we obviously need a liquidity mechanism. For liquidity, investors are not able to redeem their shares for the first 12 months. There's a 1-year lockout. After that year, you can redeem at best efforts. However, years 1 through 5, there is a discount to NAV. Now it steps down as the fund progresses. However, after year 5, you can redeem without a penalty. It's also important to note that after you sign your subscription agreement, while you are in the funding queue, you will not be paying fees on your investment. You will only be charged fees when you actually fund your capital call. And when you do, there will be a one-time upfront admin fee of anywhere from 0% to 2%, depending on how much you commit to the fund. When we add a new deal to the fund, there will be an acquisition fee of 50 basis points. Also, there will be an ongoing annual asset management fee of 125 basis points that'll be based on the net asset value of your personal investment. And there will be a performance allocation, which will be 10%, but only after a 6% preferred return is achieved for investors. In terms of how the fund works, if you'd like to participate, you begin by signing a subscription agreement. Our team will send you one, just let us know. And then you'll have to verify your accreditation. Once you do, you will join the funding queue. At this time, we'll be sure to let you know how long we anticipate before we actually call your capital. Once you get to the front of the queue, our third-party fund administrator will issue you a capital call for 100% of your commitment, so you'll fund the entire amount. At that time, you will be issued shares, but the amount of shares that you receive will be based on the share price at the time of your investment. The share price will be revalued on a quarterly basis, and it will be audited by a third party. Now, the fund projects to make distributions on a quarterly basis. However, if you opt in to the distribution reinvestment plan, or the DRIP, during the subscription process, then your distribution will be automatically reinvested and compounded. In terms of next steps, if you'd like to complete additional due diligence, you can log into your personal online account, click on the offerings page, click on IncomePlus, scroll down and you'll find the fund documents. After reviewing the documents, if you would like to invest, simply click on Indicate Interest, type in the amount, submit your request, and your personal origin contact will email you to initiate the subscription process. That's all for today's presentation. Thank you again for tuning in. We hope you feel significantly more educated on the IncomePlus Fund, and we hope to partner with you soon.